All right, so welcome into the live stream today. We're going to be diving into the FOMC meeting. It's coming up here in about 15 minutes or so. We've got a few topics to cover and really dive in deep around where this move may take the markets. We'll get into all that good stuff. My name is Paul Barron. Welcome back into TechPath. FOMC, of course, is at the top of the hour or bottom of the hour at 2:30. We'll get a chance to hear Chair Powell get into some of that. Of course, I do want to thank our sponsors today, and that is Bybit. If you guys are looking at next level trading, this is one of the places to do it, and Bybit, of course, has some pretty cool programs going on right now through the month of September. They've got their ETH Trading Fiesta, which is a trading competition doing ETH derivatives and trading with 300K in USDC prize pool, also some other derivative pairs out there. If you use our link, you'll be able to find more about this along with the perpetual airdrop that they're doing. The cool thing is if you use our link, is they're giving away some special rewards. This is only for the PBN audience. So the way it works, if you've signed up as a Bybit user, you're going to get a chance to win $200. There's going to be 5 of you that will win $200, and then there's going to be 1 of you that wins $1,000 for 1 lucky winner. So we'll be announcing, Bybit's going to send us the winners, and we'll be announcing those here on the show later in the month. So make sure and check that out. Let's jump over to a couple of things, of course. Brewing, prior to the announcement, and of course, some of you maybe already know, the 75 basis points is in. So this is in what has been expected. Some of the things that people were looking to do was traders across the world rushing to close their bets ahead of the Fed decision. And I think a lot of people were playing out more of a safeguard here. Some of the things that they were looking at, closing shorts, equities, and bonds. This is coming over from Stephen Miller. Obviously, he's also looking, he'd be closing long dollar positions. Next 24 hours are also very uncertain when the market has already worked itself into such a pessimistic lather. Now, I look at it in the sense that we saw kind of flatline sentiment coming. To me, that gives us indicators that this was all priced in, or that the anticipation of 75 basis points was priced in, and that we weren't necessarily going to see any kind of major movements. Now, granted, the scenarios that typically happen post FOMC, as you guys know, and I'll show you a chart here in a second, and we start to see a little bit of movement, and that may be the same scenario playing into it through this round. Now, granted, there's a lot of other aspects that are playing into this on a global and macroeconomic scale that I think kind of goes into it. When you look at the tweet here from our own Gareth Soloway, Gareth jumped in. Of course, if you guys have not checked out Gareth, make sure and follow him on Twitter. It's In the Money Stocks. They do a great job over there. You can learn a lot about their program just at inthemoneystocks.com. But he basically said a little bit about this on the show on Monday, and of course that is, we're expecting the 75. That's came in, number 1, so that's complete. Number 2 is the commentary about the pivoting and the future hike guidance. This is going to be what we're going to be covering here on the live stream at 2:30, so make sure and stick around for that. Smash the like button. It is very important. This will help kick the algorithm out. It's going to help people start to discover crypto for the first time, because this is going to be an event that I believe, along with some of the things around stablecoin regulation and other aspects that are positive for the crypto industry, this is an opportunity when you start to see things around the FOMC meeting for sure. Number 3, he said, was the press conference questions. This is another thing that happens in the conference itself, and there's usually a handful of reporters there that are very astute into the impact of what could happen here post FOMC and how the 75 basis points will be looked at by the market, and what this may look at on the forward-looking statements coming from Chair Powell. Number 4 is then how many will dissent with the Fed, within the Fed. And I think this is going to be something that we'll continue to take a look at, is how because remember, there's 2 things that are happening right now when you look at the current situation politically for a lot of Democrats, and then you also look at just in general the climate in DC around the pressures around inflation. And inflation is obviously the biggest challenge for the Fed, because that's their number 1 focus, is try to get inflation back down to 2%. I don't necessarily think we're going to see that in this round. I think we're going to continue to see a rise in inflation, and probably see somewhat of a new inflationary standard, somewhere between 3% and 4%. Of Question will be is how long before we actually get a chance to see that, because Fed or inflation so far has been pretty significant and continuing to rise. Remember, the next FOMC meeting will be after the midterm election. That's going to be end of November. That to me is going to be, that's why this one is so critical. This to me is a critical move over the next, really about the next 5 to 10 days on the markets, because this is going to be a little bit for the markets to digest this, what this might look like overall as well, and where this plays out. If you look at what the S&P 500 history points, this has been typical of what's happened around these in the past, and that is typically a sharp little bounce after a Fed meeting. Now, I don't necessarily call against that. I think there's a lot of other aspects within this that that play into it, but history is definitely on our side right here, where it talks about if the markets do continue in this place, we'll be right there on the bounce. The question is will this is something even Gary and I talk about often, is if the market is all pushing to this way, you always want to take a look at maybe going the alternate direction. Expectations are very hawkish, and the Fed can come out just as expected and still be more dovish than expected. This is something that I think will be identified in today's FOMC meeting, where Chair Powell really kind of breaks into what this will go into in terms of the topics and how he answers questions post-announcement. That likely limits the market downside from this meeting and just may provide some upside going forward. Extreme bearish positioning could also prove to be a source of support for stocks. Fund managers are still the most underweight in equities they've ever been. While cash levels are at their highest, we know a lot of people in the market right now, cash is king right now. We are seeing a lot of that along with stablecoins, because I do think a lot of people are waiting for or looking at the indicators that are coming in from a macro standpoint that could really push us into a new place. Stocks may rally regardless of what the Fed says, and obviously we know that now, being 75. But the volatility levels have been surging over the past couple of days, so it could be kind of a little bit of a push here. But at the same time, if there's any indicators within the post-Fed announcement, this is why it's so critical. This is what we'll get a chance to see. And we'll be charting this along with you guys, taking a look at the charts as Powell is moving, because this will, I mean, everybody's got buy orders and sell orders setting in their accounts right now, so you know what's happening, and everybody's kind of triggered right there. I'm sitting on a buy order right here on this phone, so we'll be looking at that. But it is something that I think is going to be very interesting. My anticipation is that we may be slightly on the downside in terms of the outlook from Chair Powell, and that to me could play into a negative position, but I think a lot of people are looking at a 75 basis points as a win, and that in itself I think also will kind of also play out over a short period of time before we start to see a little bit of downtrend in the market, because I do think that's coming for sure. Fed fund rate could end up as high as 5%, says overseer of about 1.3 trillion in assets. If we continue to see this, this is coming from Oaks, Pennsylvania based firm, reasonable base case that the level of which the Fed officials will stop hiking rates somewhere around 4.5 to 5. This, of course, is where we might see. I wonder if this guy's connected to. No, that's interesting. But my point is that 4.5 to 5%, that'll be the real critical measure on whether or not we continue to see more pushes in, which will tell us a lot about the lengthening cycle of how this recession, we'll call it a recession, will go, how long it's going to kind of play out there. You look at a tweet here from Jurgavin. All the countries that have done 100 basis points or larger hikes so far this year. Man, that looks bad. I mean, you just think, because these are all major, I mean, obviously with Canada, Europe, obviously with Russia, and what we've seen within the Eastern Bloc countries, Central Africa, obviously some of the Middle East. Not as bad completely, but if you pulled this into the 75 basis points, fortunately we won't join this list, which is another one. Another thing that he also tweeted on this same account was he got into a scenario around how these have gone in the past. And if you look at, let me kind of pop up, these are the rate hikes on every single FOMC hike so far this year. This is for 2022. Let me kind of go to these guys and let you take a look. So this was the July FOMC meeting, and you had a little bit of a downtrend and then sideways and then boom. Then you had June's FOMC meeting, a little bit of a downtrend, and then a really sharp hike, and then a continued sideways and up. And that was over what was a pretty short period of time. Then same thing here in May. That one was just pretty much slightly down and then off to the races. Kind of interesting. And then last, there was the March. This was the one that I thought was the most interesting, because of it was being so early in the cycle, and also what we would get a chance to see. Large downside and then the move up overall. So interesting stuff, I think, when you look at just the market trends in general and how this might play out over the next few days. The only thing that really kind of gets me a little bit skittish on this announcement, and I think some of this may come into play here. Now, you won't hear Chair Powell talk about this, but I think this is some of the pressures that will be coming from DC, and that is Putin escalating the Ukraine war, issuing a nuclear threat to the West. So this to me is, some of this is a little bit of, cannon thumping, but there is a little bit of statement here around what the West has been involved in and how this may play into it. Remember, we had Putin and Xi Jinping who had a chance to meet. That has been going on. You also have them kind of detaching away from the Western and US dollar global reserve system and starting to move in, when I say they, meaning Russia, starting to move into a new direction. And I think anytime you have a global power that is doing and making these kinds of strategic moves, because Russia, really, you have to go back all the way into the Soviet Union to see those kind of actions before. I mean, this is down into the period in which Reagan and Gorbachev pretty much got this under control, and we got out of a Cold War. That, I think, is a scenario that we may be entering into again, and that is a problem for markets. It's a problem for markets, which again goes back to the point that we've talked about, is continued macro pressures that will continue to push us into these kind of scenarios. And again, back to what what we've been talking about here on the show, is the whole scenario around where the market might be going overall in a short period of time compared to what the macro pressures are going to be doing. And then lastly here, this of course is Putin is not spoken yet, but Russia, of course, his request on this is going how to leave the country have increased. This is interesting to me because this gets into a scenario where the pressures inside Russia itself is going to start, because there's still a ton of people in Russia that are probably trying to figure out what's our government doing. And I think this is a scenario that we've seen in other European bloc countries and Eastern bloc countries that have essentially fled markets and tried to get into a better position for their families. So anytime we see these kinds of increases, it's kind of interesting to watch some of that. Let's take a look at the charts real quick and pull up TradingView. Do we have our one? Yeah. So as you can kind of see, obviously right there at the 75, we saw those two green candles. What are we on? Are we on the 5 minute? Yeah, it looks like we are. 5 minutes. So we saw the two green candles coming up right there on the 75 basis points announcement, and then 15 minute chart. Okay. And then two green candles, and then boom, we had the red candle. We're working a green candle right now off that base, which brought it down what looks like it wicked into around under 18.8, which is kind of interesting. Wondering how you guys are playing this. Make sure and put some comments in the side chat. We're going to get to some questions after Chair Powell makes his announcement and comments. We'll definitely get into that. We will be streaming that, of course, live and going into all that good stuff. Another thing too is we've got this new website that I want to kind of show you guys. Let's go to Fiat Leak real quick. Go to the full screen and let's take a look at this. This is a really cool website that shows the money flow. Right now we're looking at Bitcoin. And I'm also kind of curious if he gets a little dovish, and this is something we've talked about before, is if he does get a little dovish, the likelihood of it maybe going back up to 20K and we see a little bit of a bump there could be real. And that's something that we are watching very closely. Obviously, sentiment will be reporting sentiment later this afternoon post, because obviously the sentiment will shift with what's happening with his live stream today. And we'll be getting into some of that. All right, looks like we have a few people coming in with no sound. I think the guys are, looks like the guys, oh, it's back. Okay, cool. I love it. You know, the chart. Here we go. Let's go over to the meeting and take a look. All right, so he has not jumped in. Some of the reporters too, I think, yeah, especially the ones from Financial Times, the Bloomberg reporter has been really good about their questions. I've also seen a handful of, when you look at forward-looking statements around what the Fed is trying to do in really positioning for this, it goes back to the Wyoming point right here. Here comes Chair Powell right now. We get a chance to see what the gangster himself is going to say.
Good afternoon. My colleagues and I are strongly committed to bringing inflation back down to our 2% goal. We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised its policy interest rate by 0.75 percentage point, and we anticipate that ongoing increases will be appropriate. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. In addition, we are continuing the process of significantly reducing the size of our balance sheet. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed from the historically high growth rates of 2021, which reflected the reopening of the economy following the pandemic recession. Recent indicators point to modest growth of spending and production. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, in large part reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment, while weaker economic growth abroad is restraining exports. As shown in our summary of economic projections, since June, FOMC participants have marked down their projections for economic activity, with the median projection for real GDP growth standing at just 0.2% this year and 1.2% next year, well below the median estimate of the longer-run normal growth rate. Despite the slowdown in growth, the labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies near historical highs, and wage growth elevated. Job gains have been robust, with employment rising by an average of 378,000 jobs per month over the last 3 months. The labor market continues to be out of balance, with demand for workers substantially exceeding the supply of available workers. The labor force participation rate showed a welcome uptick in August, but has little changed since the beginning of the year. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing the upward pressure on wages and prices. The median projection in the SEP for the unemployment rate rises to 4.4% at the end of next year, a half percentage point higher than in the June projections. Over the next 3 years, the median unemployment rate runs above the median estimate of its longer-run normal level. Inflation remains well above our 2% longer-run goal. Over the 12 months ending in July, total PCE prices rose 6.3%, Excluding the volatile food and energy categories, core PCE prices rose 4.6%. In August, the 12-month change in the consumer price index was 8.3%, and the change in the core CPI was 6.3%. Price pressures remain evident across a broad range of goods and services. Although gasoline prices have turned down in recent months, they remain well above year-earlier levels, in part reflecting Russia's war against Ukraine, which has boosted prices for energy and food and has created additional upward pressure on inflation. The median projection in the SEP for total PCE inflation is 5.4% this year and falls to 2.8% next year, 2.3% in 2024, and 2% in 2025. Participants continue to see risks to inflation as weighted to the upside. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 percentage points, bringing the target range to 3 to 3.25%. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate. The pace of those increases will continue to depend on the incoming data and the evolving outlook for the economy. With today's action, we have raised interest rates by 3 percentage points this year. At some point, as the stance of monetary policy tightens further, it will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. Restoring price stability will likely require maintaining a restrictive policy stance for some time. The historical record cautions strongly against prematurely loosening policy. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 4.4% at the end of this year, 1 percentage point higher than projected in June. The median projection rises to 4.6% at the end of next year and declines to 2.9% by the end of 2025, still above the median estimate of its longer-run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. We are taking forceful and rapid steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth, and there will very likely be some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. We will keep at it until we're confident the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
All right, so I have questions coming in from the reporters, so we'll get a chance to.
Hi, Chair Powell.
I think
Thank
this
you
is
for
where
taking
some of
our
the good stuff
questions.
will be.
Gina Smilik from the New York Times. I wonder if you could give us a little detail around how you'll know when to slow down these rate increases and how you'll eventually know when to stop.
So I will answer your question directly, but I want to start here today by saying that my main message has not changed at all since Jackson Hole. The FOMC is strongly resolved to bring inflation down to 2%, and we will keep at it until the job is done. So the way we're thinking about this is the overarching focus of the committee is getting inflation back down to 2%. To accomplish that, we think we'll need to do two things in particular to achieve a period of growth below trend and also some softening in labor market conditions to foster a better balance between demand and supply in the labor market. So on the first, committee's forecasts and those of most outside forecasters do show growth running below its longer run potential this year and next year. On the second, though, so far there's only modest evidence that the labor market is cooling off. Job openings are down a bit. As you know, quits are off their all-time highs. There's some signs that some wage measures may be flattening out but not moving up. Payroll gains have moderated, but not much. And in light of the high inflation we're seeing, we think we'll need to, and in light of what I just said, we think that we'll need to bring our funds rate to a restrictive level and to keep it there for some time. So what will we be looking at, I guess, is your question. So we'll be looking at a few things. First, we'll want to see growth continuing to run below trend. We'll want to see movements in the labor market showing a return to a better balance between supply and demand. And ultimately, we'll want to see clear evidence that inflation is moving back down to 2%. So that's what we'll be looking for. In terms of reducing rates, I think we'd want to be very confident that inflation is moving back down to 2% before we would consider that.
So he's still pushing on the whole issue with Jackson Hole, which was a very hawkish
Thank you, Mr.
statement.
Chairman. Steve Leisman, CNBC. Can you talk about how you factor in the variable lags on inflation and the extent to which the outlook for rates should be seen as linear in the sense that you keep raising rates, or can you envision a time when there's a pause to kind of look at what has been wrought in the economy from the rate increases? Thank you.
Sure. So, of course, monetary policy does famously work with long and variable lags. The way I think of it is our policy decisions affect financial conditions immediately. In fact, financial conditions have usually been affected well before we actually announce our decisions. Then changes in financial conditions begin to affect economic activity fairly quickly, within a few months. But it's likely to take some time to see the full effects of changing financial conditions on inflation. So we are very much mindful for that. And that's why I noted in my opening remarks that at some point, as the stance of policy tightens further, it will become appropriate to slow the pace of rate hikes while we assess how our cumulative policy adjustments are affecting the economy and inflation. So that's how we think about that. Your second question, sorry, was? Is there a point in time that you could see pausing? Is it linear that you keep raising rates, or is there? Oh, I'm sorry.
I should know better than to not talk with my microphone.
I should know better than to answer your second question.
Oh, there you go. Is it linear? Do you keep raising rates, or is there a pause that you could envision where you kind of figure out what has happened to the economy and give time to catch up in the real economy, the rate increase time to catch up in the real economy? Thank you.
So I think it's very hard to say with precise certainty the way this is going to unfold. As I mentioned, what we think we need to do and should do is to move our policy rate to a restrictive level that's restrictive enough to bring inflation down to 2%, where we have confidence of that. And what you see in the SEP numbers is people's views as of today, as of this meeting, as to the kind of levels that will be appropriate. Now those will evolve over time, and I think we'll just have to see how that goes. There is a possibility certainly that we would go to a certain level that we're confident in and stay there for a time. But we're not at that level. Clearly today we've just moved, I think, probably into the very lowest level of what might be restrictive, and certainly in my view and in the view of the committee, there's a ways to go.
Powell, Rachel Siegel from the Washington Post. Thank you for taking our questions. The projections show the unemployment rate rising to 4.4% next year. And historically, that kind of rise in the unemployment rate would typically bring a recession with it. Should we interpret that to mean no soft landing? And is that kind of rise necessary to get inflation down?
Right. So you're right. In the SEP, there's what I would characterize as a relatively modest increase in the unemployment rate from a historical perspective, given the expected decline in inflation. Now, why is that? So really, that is what we generally expect, because we see the current situation as outside of historical experience in a number of ways, and I'll mention a couple of those. First, and you know these, but first, job openings are incredibly high relative to the number of people looking for work. It's plausible, I'll say, that job openings could come down significantly, and they need to, without as much of an increase in unemployment as has happened in earlier historical episodes. So that's one thing. In addition, in this cycle, longer run inflation expectations have generally been fairly well anchored. And as I've said, there's no basis for complacency there. But to the extent that continues to be the case, that should make it easier to restore price stability. And I guess the third thing I would point to that's different this time is that part of this inflation is caused by this series of supply shocks that we've had, beginning with the pandemic and really with the reopening of the economy, and more recently amplified and added to by Russia's invasion of Ukraine, have all contributed to the sharp increase in inflation. So these are the kinds of events that are not really seen in prior business cycles. And in principle, if those things start to get better, and we do see some evidence of the beginnings of that, it's not much more than that, but it's good to see that. For example, commodity prices look like they may have peaked for now. Supply chain disruptions are beginning to resolve. Those developments, if sustained, could help ease the pressures on inflation. So let me just say, how much these factors will turn out to really matter in this sequence of events, it remains to be seen. We have always understood that restoring price stability while achieving a relatively modest decline, or rather increase in unemployment, and a soft landing would be very challenging. And we don't know. No one knows whether this process will lead to a recession, or if so, how significant that recession would be. That's going to depend on how quickly wage and price inflation pressures come down, whether expectations remain anchored, and whether, also do we get more labor supply, which would help as well. In addition, the chances of a soft landing are likely to diminish to the extent that policy needs to be more restrictive or restrictive for longer. Nonetheless, we're committed to getting inflation back down to 2% because we think that a failure to restore price stability would mean far greater pain later on.
Just to follow up on one small thing, are vacancies still at the top of your list in terms of understanding the labor market and how much room there is there?
Yes, vacancies are still almost 2-to-1 ratio to unemployed people. That and quits are really very good ways to look at how tight the labor market is and how different it is from other cycles, where generally the unemployment rate itself is the single best indicator. We think those things have for quite a time now really added value in terms of understanding where the labor market is.
Nick.
Nick Timmeros of the Wall Street Journal. You said not too long ago in describing the policy destination, there's still a way to go. But I imagine you have to have some idea about how you're thinking about your destination, whether it's a stopping point or a pausing point. And so I was wondering if you could discuss how you are thinking about, as the data come in, where that destination is, how it's moving up if inflation doesn't perform as you expect. Do you want to have a policy rate that's above the underlying inflation rate, for example? And do you have an estimate for where you think the underlying inflation rate might be in the economy right now?
Well, so again, we believe that we need to raise our policy stance overall to a level that is
not gonna answer
restrictive.
that question.
And by that I mean is meaningfully putting meaningful downward pressure on inflation. That's what we need to see in the stance of policy. We also know that there are long and variable lengths, particularly as they relate to inflation. So it's a challenging assessment. So what do you look at? You look at broader financial conditions, as you know, you look at where rates are, real and nominal in some cases. You look at credit spreads. You look at financial conditions indexes. We also, I would think, and you see this this is something we talked about today in the meeting, and talk about in all of our meetings, and you see this, I think, in the committee forecast. You want to be at a place where real rates are positive across the entire yield curve. And I think that would be the case if you look at the numbers that we're writing down and think about, you measure those against some sort of forward-looking assessment of inflation expectations. I think you would see, at that time, you'd see positive real rates across the yield curve, and that is also an important consideration.
Interesting points, too.
Hi, Howard Schneider with Reuters. Thanks for the opportunity. I just want to be clear on the steps. You say it's meeting by meeting, but it sure looks like we're going 75, 50, 25. Is 75 next month the baseline?
So we make one decision per meeting, and the meeting decision we made today was to raise the federal funds rate by 75. You're right that the median for the year end suggests another 125 basis points in rate increases. But there's another fairly large group that saw 100 basis points addition to where we are today. So that would be 25 basis points less. So, we're going to make that decision at the meeting. We didn't make that decision today. We didn't vote on that. I would say that, we're committed to getting to a restrictive level of for the federal funds rate and getting there pretty quickly. And that's what we're thinking about.
So just as a follow-up to that, I'm wondering about the sort of risk management considerations here. Given there's some discussion now of overdoing it, what's the incentive to continue front-loading right now? Is it lack of progress on inflation seen in the CPI reports, or is it a motivation to get as much done while the job market is still as strong as it is?
So what we've seen is inflation our expectation has been that we would begin to see inflation come down, largely because of supply side healing. By now, we would have thought that we would have seen some of that. We haven't. We have seen some supply side healing, but inflation has not really come down. If you look at core PCE inflation, which is a good measure of where inflation is running now, if you look at it on a 3, 6, and 12-month trailing annualized basis, you'll see that inflation is at 4.8%, 4.5%, and 4.8%. So that's a pretty good summary of where we are with inflation, and that's not where we expected or wanted to be. So what that tells us is that we need to continue, and we can keep doing these, and we did today do another large increase as we approach the level that we think we need to get to. And we're still discovering what that level is, but people are writing that down in their SEP where they think policy needs to be. So that's how we're thinking about it.
Let's go to Colby.
A lot of analysts are still pointing to 50-50 on
Chair Powell,
50
how should
basis
we
points in
interpret
November
the
and
fact
50
that
basis
core
points in
inflation
December?
is still not forecast in the SEP to be back to target in 2025, and yet the dot plot projects cuts as early as 2024. And does that mean there's a level of inflation above the 2% target that the Fed is willing to tolerate?
So I guess core is at 2.1 in 2025, and in the median, and headline is at 2.0. So that's pretty close. I mean, we write down our forecasts and we figure out what the median is and we publish it. So it's not. I would say that if the economy followed this path, this would be a pretty good outcome. But you're right, it is a tenth higher than 2%.
Okay, just as a quick follow-up, if the concern is that underlying inflation is becoming more entrenched perhaps each month, then why forego the more aggressive 100 basis point increase today? And does that risk having to do more later on?
Yeah, so we, as we said, at the last press conference and in between that one and this one, we said that we would make our decision based on the overall data coming in. So if you remember, we got a surprisingly low reading in July.
He's definitely
and then a
not
surprisingly
letting
high,
off
surprisingly high
of
reading for
the gas
August.
pedal
So
for sure,
I think you
from
have to-
based
you
based on
can't
what
really-
he's
you never wanna
talking about right
overreact
now.
too much to any one data point. So if you look at them together, and as I just mentioned, if you really look at this year's inflation, 3, 6, and 12-month trailing, you see inflation is running too high. It's running 4.5% or above. You don't need to know much more than that. If that's the one thing you know that this committee is committed to getting to a meaningfully restrictive stance of policy and staying there until we feel confident that inflation is coming down. That's how we think about it.
Victoria.
If you look at some of the PCE
hi,
numbers that
Victoria
he's
Guido's
talking
call.
about, there is a bit of a
I wanted to ask
flattening
about,
right here. So
balance
I'm not
sheet.
sure that
You
it
all have
completely dives in
recommended
with what he's talking about.
that you might sell mortgage-backed securities, but we've seen significant slowing in the housing market. Mortgage rates have gone up significantly, and I'm just wondering whether conditions there might affect your plans for how quickly you have the runoff on the MBS side.
So what we said, as you know, was that we would consider that once balance sheet runoff is well underway. I would say it's not something we're considering right now, and not something I expect to be considering in the near term. It's just it's something I think we will turn to, but the time for turning to it has not come and is not close.
Well, and will conditions in the housing market affect that decision?
I think a number of things might affect that decision, but the main thing is we're not considering that decision, and I don't expect that we will anytime soon.
Neil.
Thanks. Neil Irwin with Axios. A number of commentators have come to the view, and including over at the World Bank, that simultaneous global tightening around the world creates a risk of a global recession that's worse than is necessary to bring inflation down. How do you see that risk? How do you think of coordination with your fellow central bankers? And is there much risk of overdoing it on a global level?
So we actually, my colleagues and I, a number of my FOMC colleagues and I just got back from one of our frequent trips to Basel, Switzerland, to meet with other senior central bank officials from around the world. We are in pretty regular contact, and we exchange. Of course, we all serve a domestic mandate, domestic objectives, in our case, the dual mandate, maximum employment and price stability. But we regularly discuss
I would agree.
what we're seeing in terms of our own economy and international spillovers. And it's a very ongoing,
Bitcoin.
constant kind of a process. So we are very aware of what's going on in other economies around the world and what that means for us and vice versa. The forecast that we put together, that our staff puts together and that we put together on our own, always try to take all of that into account. I mean, I can't say that we do it perfectly, but it's not as if we don't think about the policy decisions, monetary policy and otherwise, the economic developments that are taking place in major economies that can have an effect on the U.S. economy. That is very much baked into our own forecast and our own understanding of the U.S. economy as best we can. It won't be perfect. So, I don't see it's hard to talk about collaboration in a world where people have very different levels of interest rates. If you remember, there were coordinated cuts and raises and things like that at various times, but really we're in very different situations. But I will tell you that our contact is more or less ongoing, and it's not coordination, but there's a lot of information sharing, and we all, I think, are informed by what other important economies that are important to the United States are doing.
Craig.
We'll get a
Torres
good
from
recap
Bloomberg.
in here for sure,
Chair
guys.
Powell, you talked about
There's a
some
lot
of
in
ways
here,
the,
too.
Higher interest rates are affecting the economy, but we've also seen a resilient labor market with durable consumption, strong corporate profits. And I'm wondering what your story is on the resilience of the economy. After all, you and your colleagues said, well, we started tightening in March when we were talking about interest rates in the future. And indeed,
That's a good point right
Treasury
here.
rates moved up. So we should have had a lot of tightening taking effect. Why is the economy, in your view, so resilient? And does it mean that we might need a possibly higher terminal rate?
You're right, of course. The labor market in particular has been very strong, but there are the sectors of the economy that are most interest rate sensitive are certainly showing the effects of our tightening. And of course, the obvious example is housing, where you see declining activity and of all different kinds, and housing price increases moving down. So we're having an effect on interest-sensitive spending.
I think the market is
through
reacting a little differently,
exchange rates, we're having an
even to what
effect
I'm hearing within this. I just saw a
exports and
tweet come up from
imports.
Gareth as well in
I
terms
think,
of a little bit more hawkish.
So
But
all of that's happening.
there's some things here we'll
But
cover
you're right,
in the
it's
recap
and
because I think
we've-
that it's
we've
really
said this,
important.
This is a strong, robust economy. People have savings on their balance sheet
We'll definitely do some
from the
Q&A,
period when
yes.
they couldn't spend and where they were getting government transfers. There's still very significant savings out there, although not as much at the lower
love
end
for the
of the
SEC
income
and
spectrum, but
comments
still
today.
some savings out there to support growth. The states
Fed.
are very flush with cash.
Thinking SEC.
So there's a good reason to think that this will continue to be a reasonably strong economy. Now the data sort of are showing that growth is going to be below trend this year. We think of trend as being about 1.8% or in that range. We're forecasting growth well below that, and most forecasters are. But you're right. There's certainly a possibility that growth can be stronger than that, and that's a good thing because that means the economy will be more resistant to to a significant downturn. But of course we are focused on the thing I started with, which is getting inflation back down to 2%. We can't fail to do that. If we were to fail to do that, that would be the thing that would be most painful for the people that we serve. So for now, that has to be our overarching focus. And you see that, I think, in the SEP, in the levels of rates that we'll be moving to reasonably quickly, assuming things turn out roughly in line with the SEP. So that's how we think about it.
Thank you, Mr. Chairman. In a world of euphemisms that we live in here with below-trend growth and a modest increase in unemployment, I'm wondering if I could ask you a couple of direct questions for the American people. Do the odds now favor, given where you are and where you're going with interest rates, favor a recession? 4.4% unemployment is about 1.3 million jobs. Is that acceptable job loss? And then given that the data you look at is backward-looking and the lags in your policy are forward-looking and you don't know what they are, how will you know, or will you know, if you've gone too far?
So I don't know what the odds are. I think that there's a very high likelihood that we'll have a period of what I've mentioned is below trend growth, by which I mean much lower growth, and we're seeing that now. So the median forecast, I think, this year for among my colleagues and me was 0.2% growth. So that's very slow growth, and then below trend next year. I think the median was 1.2, also well below. So that's a slower. It's a very slow level of growth, and it could give rise to increases in unemployment. But I think that is something that we think we need to have, and we think we need to have softer labor market conditions as well. We're never going to say that there are too many people working, but the real point is this. Inflation, what we hear from people when we meet with them is that they really are suffering from inflation. And if we want to set ourselves up, really light the way to another period of a very strong labor market, we have got to get inflation behind us. I wish there were a painless way to do that. There isn't. So what we need to do is get rates up to the point where we're putting meaningful downward pressure on inflation, and that's what we're doing. And we certainly don't hope. We certainly haven't given up the idea that we can have a relatively modest increase in unemployment. Nonetheless, we need to complete this task.
But how will you know, or will you know?
I'm so fascinated that they actually think we're going to get to a 2%.
Hard to hypothetically deal with that
there's
question. I mean,
no path that they've even
our really tight
laid
focus
out.
now continues to be ongoing rate increases to get the policy rate up where it needs to be. And as I said, you can look at this SEP as today's estimate
This is
of
where
where we
could
think those
see
rates
an
would be. Of course, they will.
Is as he just said there, ongoing policy rate increases, which that is the concern, I think, is the overcorrection scenario that we could see.
Mentioned about the labor market, you've said several times that to have the labor market we want, we need price stability and you've suggested maybe there isn't a trade-off in the long run, but in the short run, there is a lot of concern, as people have been expressing here, about higher unemployment as a result of these rate hikes, or as a result of the rate hikes. So can you explain, though, what about high inflation now threatens the job market? I mean, you seem to suggest that inflation, high inflation will eventually lead to a weaker job market. So can you spell that out a little more for the general public and how that would work?
So for starters, people are seeing their wage increases, their wage increases eaten up by inflation. So if your family is one where you spend most of your paycheck, every paycheck cycle, on gas, food, transportation, clothing, basics of life, and prices go up the way they've been going up, you're in trouble right away. You don't have a cushion, and this is very painful for people at the lower end of the income and wealth spectrum. So that's what we're hearing from people is, it very much that inflation is really hurting. So how do we get rid of inflation?
These guys
and as I mentioned, it would be nice if there were, a way to just wish it away, but there isn't. We have to get supply and demand back into alignment, and the way we do that is by slowing the economy. Hopefully, we do that by slowing the economy, and we see some softening in labor market conditions, and we see a big contribution from supply side, improvements and things like that. But none of that is guaranteed. In any case, our job is to deliver price stability, and I think you can think of price stability as an asset that just delivers large benefits to society over a long period of time. We really saw that for a long time. The United States had 2% inflation, didn't move around much, and that was enormously beneficial to the public that we serve. And we have to get back to that and keep it for another long period of time. To pull back from the task of doing that is you're just postponing. The record shows that if you postpone that, the delay is only likely to lead to more pain. So, I think we're moving to do what we need to do and do our jobs, and that's what you see us doing.
Thank you for taking the question, Mr. Chairman. Edward Lawrence for Fox Business. So you had said that Americans and businesses need to feel some economic pain as we go forward. How long from here should Americans be prepared for that economic pain?
How long? I mean, it really depends on how long it takes for wages and more than that, prices to come down, for inflation to come down.
On the beginning, really sticking to his guns about Wyoming, and I'm just talking over this because that question's been answered. He'll dodge that one. But he started to move in a little bit more hawkish again, or a little dovish, right there in the middle of the speech, and answering some of the questions. But the biggest question, I think, is going to be talking about the data that they're relying on to be able to assess how they're going to address this going forward. They don't seem to know.
That the costs in unemployment they're meaningful, and they're certainly very meaningful to the people who lose their jobs. And we talk about that in our meetings quite a lot. But at the same time, we'd be setting the economy up for another long period. This era has been noted for very long expansions. We've had 3 of the 4 longest in measured history since we got inflation under control.
Yeah,
and that's not an accident. So when inflation is low and stable, you can have these 9, 10, 11, 10-year, expansions, and you can see what we saw in 2018, 19, and 20, which was very low unemployment, the biggest wage gains going to people at the low end of the spectrum, the smallest racial gaps that we've seen in since we started keeping track of that. So we want to get back to that, but to get there, we're going to have to get supply and demand back in alignment, and that's going to take tight monetary policy for a period of time.
Guys, if you like this kind of...
What is that economic pain in your mind? Is it job losses? Is it higher interest rates on credit cards? What is that economic pain?
So it's all of those things. Higher interest rates, slower
Make sure
growth,
and hit the like button. That's the main thing. If you like these kinds of overviews and analysis, is like when we do these kind of these restreams. Love to know if you like it. If you do, if you want us to continue to do these kind of things where we do analysis post discussion,
down the road
smash the like button and make sure you subscribe.
At a time when actually now people have really come to expect high inflation. If the concept of high inflation becomes entrenched in people's economic thinking about their decisions, then sort of getting back to price stability, the cost of getting back to price stability just rises. And so we want to avoid that. We want to act aggressively now and get this job done and keep at it until it's done.
Nicole from CNN. Thank you, Chairman Powell. Nicole Goodkind, CNN Business. Existing home sales have fallen for 7 months straight. Mortgage rates are at their highest level since 2008. Yet mortgage demand increased this week, and housing prices are still elevated. Now, at the end of your June press conference, you mentioned plans to reset the housing market. I was wondering if you could elaborate on what you mean when you say reset, and what you think it will take to actually get there.
So when I say reset, I'm not looking at a particular specific, set of data or anything. What I'm really saying is that we've had a time of a red hot housing market all over the country, where, famously houses were selling to the first buyer at 10% above the ask before even seeing the house, that kind of thing. So there was a big imbalance between supply and demand. Housing prices were going up at an unsustainably fast level. So the deceleration in housing prices that we're seeing should help bring sort of prices more closely in line with rents and other housing market fundamentals. And that's a good thing. For the longer term, what we need is supply and demand to get better aligned so that housing prices go up at a reasonable level, at a reasonable pace, and that people can afford houses again. And I think we probably in the housing market have to go through a correction to get back to that place. There are also longer run issues though with the housing market, as you know, where it's difficult to find lots now close enough to cities and things like that. So builders are having a hard time getting zoning and lots and workers and materials and things like that. But from a sort of business cycle standpoint, this difficult correction should put the housing market back into better balance.
He has some good
Shelter
points
made
in
up such
here.
a large
There's been
part
some
of this
interesting
hot
aspects
CPI
around where this
report
may
that we
lead
saw.
into. I feel like
Do
the
you
pressure is
think
going to be
that
on
there is a
still
lag and that we will
with
see
what
that
they're
come
talking
down in
about.
coming months, or do you think that there's still this imbalance that needs to be addressed?
I think that shelter inflation is going to remain high for some time. We're looking for it to come down, but it's not exactly clear when that will happen.
For sure.
So it may take some time. So I think hope for the best, plan
Again,
for the
the big
worst. So
question
I
here is
think on
going to be the
shelter inflation,
overcorrection. Do they
just gotta
push
assume
into
that it's gonna remain pretty
overcorrection
high for a while.
with a 50 in November, a 50 in December, which is kind of what people are looking at right now, at least on other analysts.
You've talked about the need to get real rates into positive territory, and you said earlier that policy is just moving into that territory now. So I'm curious, how restrictive is rates at 4.6% expected? Is that expected to be
Whole market
next
is
year?
slightly up.
How restrictive?
So I think if you look, when we get to, let's assume we do get to that level, which I think is likely, what you're going to do is you're going to adjust that for some forward-looking measure of inflation, and that could be, you pick your measure. It could be, there are all kinds of different things you can pick and you get. But what you'll get is a positive number. In all cases, you will get forward inflation expectations in the short term, I think, that are going to be, assuming that we're doing our jobs appropriately, that will be significant. So you'll have a positive federal funds rate at that point, which could be 1% or so. But I mean, I don't know exactly what it would be, but it would be significantly positive when we get to that level.
We've
and
talked
let me
about
say,
real estate being a
we've
problem.
written down what we think is a plausible path for the federal funds rate. The path that we actually execute will be enough. It will be enough to restore price stability. So this is something that, as you can see, they've moved up, and we're going to continue to watch incoming data and the evolving outlook and ask ourselves whether our policy is in the right place as we go. Thank you very much.
Interesting stuff coming over from Chair Powell today. If you look at the current trade, or just our trading, let's jump to my trading view right here. This is our current CPI list. So this runs all the CPI tokens that we track all the time. But if you look here, I mean, almost everything is in the green right now. So I think a lot of the market has looked at this as a bit dovish. In the percentage of, this is even going down into the gaming tokens, Metaverse, when we track, there's Gala up a 7, Sandbase up 3.8, You guys got that. All right. 3.8. There's Steppen going, Sandbox going up 3.8, Steppen going up 3.3. You've got Theta up 4. I mean, there's quite a bit of I think, what I will say is a little bit false, and this is false hope, and this is something that we've talked about before, is that his position in the beginning of the discussion and the answers to the reporters, he was staying on point with a very hawkish position. He got a little bit dovish in the middle in the sense where he was trying to backtrack a little bit around the data points, which is one of the things, as you guys know, we've covered on this show many times, is the Federal Reserve uses polling systems, not actual data, but polling systems, which easily is the most fallible. And one of the things that I think that the Federal Reserve, which I'm still surprised that they do not do, is tie into just credit card data coming from the major merchant processors, which really would give them a lot more indicators, not only on price controls, but also price volume and the velocity of money within the country, and especially around times like right now, which is dealing with understanding whether or not we're starting to see a velocity of money change around what true inflation is going to happen. Because remember, street inflation versus what the Fed is dealing with is completely different. And in many cases, people will even say that what Powell usually gets to, that's why all these things are typically predicted. Rarely do we see, outside of the one surprise we saw in the summer, rarely do we see a surprise on these. So I think this is something that we are going to continue to see the traditional trajectory that we've been talking about pretty much for the last 6 months, and that is Q3, Q4, which we are now entering, is going to be the tell-all for this recession and the likelihood of us really understanding whether or not we'll start to see an over-tightening. And this is points that Gareth has made many times, is that over-tightening can definitely come in for sure. I know we got a poll jumping in here. Let's take a look real quick. 24 hours following today's Fed meeting, crypto market will have crashed, remaining unchanged. All right, everybody thinks this is going to go down too. Now I got to almost go the other way. I'm going to have to front run you guys the other way. But the point being is this, is I think from what his statements were, the lack of data is a real problem. The scenario that they don't really understand between now, and this is bad for, I think, the midterms, because this is not a good thing for the market. In essence, we'll probably see a little bit of a bounce. Yes, we'll see those kind of correction points, but these are, I think, more manipulation within traders. Most likely we'll see a correction coming down. And this may be the scenario where we get this little pump. And we've talked about this, if you guys follow us on the mastermind or in our Crypto Power Index, where we talk about the sentiment data and where all these moves are happening. We're going to be publishing sentiment data right now, post FOMC. We're going to record those on the current tokens, so we'll get a chance to take a look at how these might perform over the next little bit. And just don't forget that there's a couple of things right here. There was a couple of articles I wanted to kind of final up here. This one right here, which is their quantitative tightening. This is a big deal right here, which is a maximum pace of 95 billion running up up to 60 billion in treasuries, 35 billion in mortgage securities. Since June, the monthly cap has been a total of only 47.5 billion, but last month the Fed only ran down its portfolio by only 22 billion. That was after 275 basis points. So to me, that tells me that the Fed is still got a heavy hand here. And they have to, because if they're trying to alter the course of their balance sheet, be able to correct what happens in inflation, I don't think they get back to 2%. I think we have a new norm around 3 to 4%, 3.5% inflation. And I think right now the stock market is going to be reeling with this. And we're going to have a lot of analysts, I think, that will look at this as still a very hawkish statement, with the sense, not necessarily of how he presented it, because there were some points in there where he was backing off slightly. It gives me a little bit of hope that there may be some correction or possibly a 25 basis points ahead of us this year. Right now, I still feel that we're going to see the 50 in November and December, which still will be on track with what their target zones were for overall interest rate control. And I think that is the thing that plays into this, guys, because this is the thing that we want to watch out for all the time. Where is the next opportunity for us to see a downtrend in a market? I know these are downtrends. We are definitely going to stay in a bear market. I think this might be another 12 months coming Based on what we're seeing right now, the key here will be Q4 earnings. Gareth and I talked about this on Q1, how the response comes from year-end retail sales, which will tell us a lot about what's going to go into the first quarter of next year. That in itself, along with the scenarios that we see from global macro pressures, which I still think are still yet to come, real estate will catch up, meaning in the sense that the market crash will catch up with what's been happening in stocks and crypto early Q1, Q2. And at that point, we'll start to see some correction in that market. At that point, this is where it could get very intriguing, because I think how Powell responds in the first quarter of next year is going to be critical. So very good stuff. We're going to continue to rock on these. If you guys like these kinds of, as I said, smash the like button if this is the kind of content you like. If you like more of our analysis, more of our interviews, maybe you just like the channel in general. And I'd love to kind of get your feedback though. What is most favorite? Technical analysis, project interviews, where we break down a lot of the metaverse and gaming projects, more of these kinds of things where we'll do some restreams, things of that nature. Just drop it in below. And maybe if we're not doing something that you guys think we should be doing in terms of research, let us know. That's how it works here with audience participation. We love to get your feedback. Of course, I don't think we got a ton of questions coming in. It looks like everybody was, we kind of covered so many on screen there. Hopefully we covered a lot of that for you guys. If you're listening in post-event here, you just missed a big live stream. And the key here of catching these kind of live streams is to subscribe over here on the YouTube channel. Jump in over here. It's very easy. Just search Paul Barron Network. You'll find us. Hit subscribe, like a few videos. That's going to get you into that algorithm, the YouTube cycle of death that is going to give you information on hopefully your journey around digital assets, crypto, and what we will see, I think, in the future around blockchain gaming and metaverse. So a lot happening. Don't sleep on this market right now, guys. This is going to be a very interesting next few days and through the weekend. We got to get people in here. We'll get people on. We are always reaching out. If you know somebody, make sure tweet them, tag us, say, hey, we would love to get you on Paul's show. And if they're, if it's someone that is reasonable and is, has a real position in the market, has an opinion, and there is some validity to what they're talking about and saying, we always love to talk to people like that. All right, we definitely will get back in on this ASAP. Lots more coming this week, sir. So make sure and stick around for the channel. If you guys want to reach me, it is out there on Twitter @Paul Barron. We'll catch you next time right here on TechPath.